Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist and Portfolio Manager at Barometer, also the president of our firm. During this webcast, we will provide you with a brief macro overview, and of course, as always, we'd be pleased to address your questions, so don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the chat via the Zoom link. There's a Q&A and a chat queue, so don't be shy, email me or text. I turn the conversation over to David. We have a lot to discuss, certainly very focused on geopolitical aspects, and we will be pleased to address those questions at the tail end. So David, I turn the conversation over to you. Good afternoon.
Hi, Pam. How are you?
Great, thank you.
Thanks, everybody, for joining today. Obviously, it's a stressful time for a lot of people. We have folks within the firm who have family members in the Ukraine. It's been a difficult time to sort through the tea leaves and make sure that we're making good decisions for the portfolios. But everybody's focused, and we're using all the tools that we have to make the best decisions that we can make. Because as we always say, there's a lot of things that move markets. The market's a big machine. There's 1,000 moving parts. And ultimately, we have to use the tools that we have to understand what the market of the message is telling us. So we're going to try and walk through that today. So just off the top, as always, our base belief is we are in a structural bull market in equities, led by U.S. markets that kicked off in 2013. And we're now 9 years into what has been a very productive bull market, but certainly has had lots of pullbacks along the way. Not dissimilar to what happened in the 1980s and 90s, and not dissimilar to the period between 1951 and 1966. Sort of 4 steps forward with 1 step back. And the 1 step back is always painful because they are short and sharp in the bull market. They tend to come sort of out of nowhere. And resolve quickly and go on to make new highs. And the most difficult thing to do in a structural bull market is to stay invested, because those little surprises will serve to shake you out and leave you uninvested as the market runs away back to new highs. The S&P, if we look at the chart sort of since 1980, the structural bull market of 1981 through 2000 was just over 1,000% return, 10 times your money in 214 months. We are at this point a fraction of that, having only really just begun a few years ago. Certainly there have been pullbacks, and this one, that again feels sloppy out there, is sort of in line with previous pullbacks. This was the bear market in 2020 going into the COVID pandemic. This is the 2018 pullback, which certainly was very sharp and painful at the time. This is the pullback in 2015-16, but they're not dissimilar to the ones that were experienced in the 80s and 90s. Certainly nothing of the order of the crash in 1987. And the conditions today are completely different than the conditions in that period. When we look at fixed income and rates, we have been making a case that sort of 40 years of falling interest rates probably has come to an end. And it looks to us like we saw a generational bottom in March of 2020. And certainly yields have been working their way higher since then. So this is the 10-year US Treasury. That was the low in March of 20. We've been making higher lows ever since in yield. And interestingly, yields, 10-year yields in the early part of 2022 moved fairly sharply higher. And here we have a major global conflict, which involves a lot of people sitting right on the edge of Western Europe. And surprisingly, really, yields have pulled back very little. In other words, there's been very little of flight to safety. When we look at 2-year yields, yes, they pulled back initially when the war began. But here we are today, basically with 2-year yields looking to close at a new high at 1.62%. Keep in mind, these were at 20 basis points in September of last year. So 0.2 of 1% to 1.6. Clearly, that is reflecting a view that the Fed is into an interest rate hiking cycle. They also reflect the fact that there is inflation in the system. And the Fed's been very clear, if they feel they need to be tough with interest rates to work on inflation, they will go ahead and do that. We're also, so from a bond pricing perspective, this is the aggregate bond index. This is the AGG ETF. It started falling in August of 2020. Since then, it's down about 11%. Again, a small bump up in the price of bonds going into war. And here they're selling off again now down near the lows. That's an aggregate index of various issuers and maturities and credit qualities. So that's a broad measure of the bond market. If we look at, say, the long end of the US bond market, since the beginning of this bear market in bonds, it's down 25.98% at the lows, and we're really not far off those lows. So bond market, a difficult place to be. We have not been advocates of holding bonds. The only bonds really we hold from a firm perspective is the minimum allocation that we have to hold in our balance mandate, which is 25%. They're held in very short-term bonds with very little interest rate risk. And we do hold some amount of cash that we have in portfolios, again, in very short-term bonds, really more like sort of 1 year and less in duration. We've been making a case that we were going through a generational bottoming in commodity prices. And this is the RJI equally weighted commodity price index, has been moving smartly higher since the beginning of 2020, so just over a year, and really has accelerated over the last number of months, 1, 2, 3, 4 months. And to put it in perspective, after a very long period of time where commodities underperformed equities, they are sharply outperforming equities today. So this has been an important theme for us. We think there's risk comes in a lot of ways to investors. One of them is that share prices fall. Another one is that you get holding assets that are unprotected from inflation in a period of inflation. And so it appears to us like we entered a reflationary period in 2020. It has turned into quite an inflationary environment currently. We don't know how long that will last. We don't know what catalyst may come, but what we can say is the market is taking it very seriously, and the aggregate of all of the various commodities was moving higher for months and months. So often a sharp move is driven out of a setup that was already there. So we already have seen tight supply in commodities. One reason is because we've had a 10-year bear market in commodities. And so producers were not all that interested in building new capacity. And as demand has caught up with supply, we now have a tight market across almost all major commodities, and a war breaks out. And of course, Ukraine and Russia are major suppliers of grains, major suppliers of metals, major suppliers of energy. And this is one more hit to an already strong market. So commodity prices certainly moving higher. You can see it, first of all, in oil prices. We are making now multi-year highs in oil prices. We haven't seen prices where we are today since 2014 in the beginning of the bear market. We moved sharply higher, of course, over the last week and the last 2 weeks. It's not just because of the Ukraine and Russia. We had exceedingly low inventories coming into this period. So when you have low inventories and very little new supply, and then you take significant capacity in the form of the second largest exporter in the world out of the equation, it's a cause for continuation. So we think it's likely that oil prices continue to work their way higher. And as a result, oil equities are probably going to perform pretty well. Beyond energy, base metals have been trending higher through the course of the year. This is an aggregate of aluminum, copper, nickel, zinc, and iron ore. And certainly we've had an acceleration since the invasion took place. But again, this is a market that was already set up to do this, and this is just pouring accelerant on the situation. Grains are in the similar situation. Corn, wheat, soybeans have been working their way higher through the course of the year, accelerated over the last little while. So this is why it's so important to look for strong setups, markets that are telling you that they are in tight supply demand, to get positioned so that when there is a new catalyst, you're not chasing after the crowd. So certainly Ukraine and Russia account for 25% of global grains trade. This is a significant development for this group. Outside of the other materials, we've talked for quite some time about the very long-term constructive technical setup for precious metals. And it didn't take very much to break out of this consolidation that went on about 13 months. And again, gold's moving sharply higher. We've closed at today at the highest price we've seen in well over 15 years. So commodities strong, fixed income weak, equities in a long-term bull market, but tactically, how do we look at things? The S&P made a high at the end of 2021, and since then made a recent low off just under 15% at the low tick. We made a low on January 24th. We made a low on the day of the Russian invasion. And since then, the news has been grim and confidence is far and few between. So here we are as of today. This is from about 3:45. Market's still holding above that low from February the 24th. But let's just take a look at some sort of internal indicators. The NASDAQ has been weaker than the S&P 500. Now, the large NASDAQ companies are a big part of the S&P 500, those big six stocks. You can see that the NASDAQ at the worst point down 22%. We're really not far off of that. We still have not made a new low in the NASDAQ 100 since February 24th, but certainly it's been weaker than the S&P. Let's look for some clues. Well, as you know, we like to look at VIX, or the readings or measures of volatility. That's expectation that market participants have of future volatility. Now, when the market made its first low in January, volatility spiked to 38. When the market made a lower low on the Ukrainian invasion, strangely, volatility did not exceed the high from January. It made a lower high. And here yesterday, the S&P went back and very closely tested the lows again, and again made a lower high, and closing today at a lower level. So one of the things that we like to watch for is a non-confirmation. It's that the market is starting to have assimilated the news and to have assimilated the conditions, as uncertain as they are, and assessing whether we think volatility is going higher or lower. And at this point, the market is not pricing in significant new volatility. But there's lots of trouble out there. We always talk about the fact that there's a problem and the things closest to the problem get impacted first. This is the Europe Stocks 50 index. So this index was doing quite well coming into the end of the year. In fact, over the month of October and November was outperforming US markets. But you can see since then it's started to weaken. And from the highs down just about 27%, today closing just above the lows from yesterday. So this is an area that's problematic. Certainly, the most problematic place in the world would be the Russian stock market. The ETFs that trade this market are now halted. The RSX was down 85% from the highs when it was halted. And at that point, it was trading at a price that was 3 times the value of its holdings. So this is the epicenter of the problem. And the markets that are further away from the problem are having considerably less impact. So let's talk a little bit about some of the leadership themes. Certainly metals and mining performing very, very well, coming out of a multi-year base. Value also performing well. We're going to jump ahead here a little bit. We're going to talk a little bit about what we're seeing going on internally in the market underneath the surface to give us clues. As you know, one thing is to watch an index, but an index is dominated by the largest, biggest market caps. What happens under the surface to the average company is of more interest to us. We know when we go through a decline, the weakest securities sell off first, the things that are closest to the problem. And then often as time goes by, more and more securities participate at the downside until almost everything is being impacted. Now, at those rotten times when very little is doing well, often for some reason, some securities will quietly turn higher. These are the ones that the professionals are looking for, the companies they have the most confidence in, so that despite a weak environment, they quietly start going higher. This is the bargain hunters. And very often, those are the strongest companies. Those are the companies people have the most confidence in. If enough companies turn higher, eventually the index will start turning higher. And as things get better, more and more companies participate in a rally. So to us, a constructive environment is where a higher and higher percent of stocks within the index are performing well. And we run this process against 300 different universes of securities, sectors, themes, geographic regions, and asset classes. Our job is to identify improving breadth. It shows us where the money's getting put to work, often before you see it in an index. Now, similarly, at some point, there's a problem, and not everything sells off first. The weakest securities sell off at the beginning, often while the largest securities or the leaders carry the index on or the group on to new highs. But if enough securities roll over, pretty soon, the index will roll over, becomes more obvious to people, and then one by one, securities go the other way. So deterioration in breadth is the thing that we're afraid of. That's the thing that causes us to become cautious. In the end, Barometer is more about trying to be a good seller than it is to be a good buyer. Our first and number one job is to make sure that a little mistake doesn't turn into a big one. So when we see deteriorating breadth in a sector or a market or a theme or an asset class, our first job is to raise some cash to tighten up the stop losses that we have on our underlying positions. And to the extent we get stopped out, no new money goes into that universe or that bucket until we start to see expanding breadth again. So let's talk about what we're seeing. Surprisingly, while the market has been plumbing lows, the percent of stocks in the NYSE that are in uptrends has slowly been rising recently. Same thing has been the case in Canada. Now, globally, there has been some weakening breadth, most specifically in Europe. But it's interesting because that tells us that the market is absorbing news quite effectively. We also know that some of the short-term indicators have been improving since the first low. So at the end of December, only 22% of companies in the NYSE were trading above their 50-day moving average. And on each pullback we've seen since then, we've pulled back to higher lows. So in effect, at the end of January, 26% of stocks were above their 50-day moving average. When Russia invaded Ukraine, 30% of stocks were trading above their 50-day moving average. And as we sit today, just over 32% of stocks trading above their 50-day moving average. So in other words, each successive lower low or pullback in the market has taken fewer and fewer companies back to lows. When we look at the percent of stocks with positive weekly price momentum at the end of December, only 16% of stocks had upward trajectory. And since then, we've seen a series of higher lows in that reading. Today, 50% of stocks have positive upward trajectory. So these are clues that tell us that the market is working its way through the uncertainty. Markets participants are making assessments as to where the risks lie and where the risks may not be, where the opportunities may lie. And our job is to try and focus in on those areas. We know that sentiment is weak. We put this up last week. The net between bullish investors and bearish investors is as low as it's been since the pandemic low in March of 2020. So when we get to a point where there are so few bulls and so many bears, it tends to be you're going through a bottoming process in markets. When we look at positioning, so we're looking at whether people are heavily positioned or lightly positioned. We're looking at hedge fund weightings here. We see that, again, hedge fund positioning has become extremely light, which means nobody's out over their skis, or let's not say nobody, but very few people out over their skis. My guess is, by the way, that nickel acted overnight at one point up 100%. Somebody's out over their skis short nickel, but that's one particular situation in the market. Let's talk about credit spreads. So the amount that a corporate borrower has to pay relative to a government issuer to issue bonds. you can see that both for high yield bonds and investment grade bonds, the excess return of the spread has been widening, and that's something that we're watching. It means that whether investors are concerned that rising rates may put pressure on lower quality borrowers, or whether rising oil prices might put pressure on companies as their costs go higher, that is an issue. But let's be clear, it's nowhere near where we get to when we have a significant problem in the market. If we put it in long-term context, yes, we've seen a widening in credit spreads, but we're really sort of in the average area that we've been in for the last number of years. And some might say the reason the spreads got so tight was because of the Fed's bond buying program, buying corporate bonds in the market. At this point, not a reason for concern. So internally, breadth does appear to be getting better. Sentiment has turned decidedly bearish. Positioning is fairly light. And credit markets, while showing a little bit of stress in the US, really not something to be majorly concerned about. Now let's look at the market and what it's telling us from a leadership perspective. Well, first of all, clearly energy is leading this market. This is the XEG, which is the TSX Capped Energy Index, an index made up of energy producers. We made a new absolute and relative high today, and it should be no surprise. Oil traded at $130 a barrel earlier in the day, backed off a little bit through the day. But the fact is energy pricing is going higher, and analysts are having to assess the likelihood that cash flows might and will go higher. The question is how high and how long this can go on for. Given the fact that inventories are so low and we've taken out another significant source of supply from the market as the US has banned energy imports from Russia today, this is likely to go on for some time. This is the US Oil Producers Index, same thing, new absolute and relative high today. But again, this is a theme that had been in place for many, many months leading into the Russian conflict. And of course, if you think that they're going to ban more imports into the US from Russia, it makes sense that oil services companies have had a pretty good week, given the fact that we're likely to see increased drilling in the US, despite the fact that the Democrats politically are against expanding it. Let's move from carbon-based energy to alternative energy. Uranium this week, having a very good week. This is the U.UN Sprott Physical Uranium Trust. This is a trust that holds physical uranium. If we were to look at the uranium producers, they had a very similar week, but certainly, again, strengthening coming into this situation, consolidated through the months of October, November, and December, but blasting off this week. So energy exceedingly strong over the last few weeks and months. Let's move from energy to mining, minerals, base metals, and golds. So these are companies such as Alcoa, Newmont, Freeport-McMoRan, Cleveland Cliffs, Royal Gold, Commercial Metals. These are the big suppliers of copper, aluminum, and nickel, making a new high today. If you take that and put it in perspective, we've talked about the fact that there has been a large technical structure or base building that's gone on over the last 5 or 6 years, a period in which, because there was no performance in the shares, there was really no new production that came on. Of course, now we get to a tight market and you have a catalyst and the market takes off. This is an area we focused in because it was an area that could give us inflation protection. When we look at some of the names in the group, companies that we own, Freeport-McMoRan, this is First Quantum, Canadian company. It produces copper. Teck Resources, again, one we've talked about over the course of the last year, all of them working their way higher, making new relative highs versus the market today. Let's go to the golds for a second. This is the share price of Newmont. It's a very long-term chart back to 1988. In fact, today, Newmont traded at the highest level it ever traded at in its history. Again, after breaking out a very, very long sideways period, I think this probably signals a move that moves significantly higher. So really all across basic materials, things continue to improve. And that's without talking about agricultural commodities, which of course, Ukraine is the breadbasket of the US, or sorry, of the world, sorry, of Europe. We've talked about this over the last couple of years. Agricultural commodities have been working their way higher. That's, again, grains, wheat, corn, soybeans, so on. This is the DBA, which is an index of agricultural companies that supply into that market. And so certainly this has been a very strong group. We have holdings in Nutrien, which is fertilizer and retail into agriculture, and Mosaic. We also own CF Industries. So pretty clear leadership coming from this whole commodity complex and basic materials complex. Why it doesn't show up in the index? It's 4% of the S&P 500. So while it may be important to us and very clear leadership in the market, not having much of an impact on the index. And certainly if you're an index investor, you get a little bit of a benefit from it. The difficult thing is there are many groups that are not performing well. So energy as one core theme continues very strong. Basic materials, another core theme, very, very strong. Let's talk about financials. Now, in the last week, we know that the US shut down Russia's access to the SWIFT network. It does throw a spanner into the works for certainly Russia's largest banks. There are potential risks that are posed to European banks and their counterparties. And the market has responded to this, European banks getting hurt. Some of the US banks that are more internationally focused, like Citigroup, for instance, did have a more difficult week. This is the Canadian Banks Equal Weight Index. Really not very much impact. It certainly has pulled back a little bit. Relative to the S&P 500, we're almost at a new high relative to the S&P. So the group continues to behave quite well. And we see a little bit more impact in the US large banks. This is the KBE ETF, made up of a basket of the largest US banks, each of them about 1.5% of the index. You can see relative to the S&P still performing quite well, but we did see it pull back over the course of the week. We did reduce some positions. We'll talk a little bit about that when we get to positioning. But overall, financials acting in line or better than the market. A far cry different than what happened in European financials, which were down sharply over the course of the week. A couple of other core themes we've been talking about. We've talked about aerospace and specifically defense. We do have holdings in General Dynamics, which had a very, very good week. Their tactical battle systems and naval systems for underwater use, predominantly in the South China Sea. Lockheed Martin, of course, had a very strong month. Raytheon had a very good month. Northrop Grumman had a very good month. These are all companies that we invested in, partly because of the ramp up in spending for military defense, but also for the fact that all of the contracts that they sign, all of these companies have inflation protection built into their pricing. So very well inflation protected. So switching over to the income world, dividend growth continues to act very well. This is the FDL ETF for those that are looking for just a single stock holding that's going to give them a decent dividends, 3.5% dividend yield. It's been growing its dividend about 10% a year. We think that makes it a really attractive investment in a rising rate environment. It's a proxy for what we've been doing in our income portfolio. Now, I think our stock selection probably is better than owning this broad basket of securities. But the whole idea here is if we're having rising interest rates, we need a rising stream of dividends to offset rising interest rates. And you can see just how well this basket is doing relative to the S&P, trading better than 88% of all the companies in the S&P in the last 12 months. So dividend growth continues to be a leading theme. So lots of things aren't working. Lots of things we're having to avoid. Consumer discretionary acting well up until the end of October certainly has had a more difficult time. Rising commodity prices and rising inflation and rising interest rates could potentially put pressure on the spending habits of the average consumer. We've also seen weakness in some industrials. Now, this is not such a terrible chart. You can see that relative strength versus the S&P is not that bad, but it is choppy. It is trading below the long-term moving averages. We do have a discipline. Within the industrials group, the railroads are behaving quite well, and the defense stocks behaving quite well, but the broader list not so well. So we have some targeted holdings here, but still relatively quite small in the portfolios. Communications having a very tough time. Now, interesting, the communications sector used to be made up of telecom stocks and cable companies. A number of years ago, they decided it was time to add social media into the group. And sadly, none of them are doing very well. So you can see relative to the S&P, this group has been failing since August. We have very little holdings here. Healthcare in general has been difficult, biotech in particular, and pharma, areas to avoid. And then, of course, there's technology. Technology today made a new relative low versus the S&P. I'm using the IGM ETF, which is a select group of technology companies, the large caps on down the list. But the reality is that the tide has been going out on technology large caps since October. And if we go to the smaller caps, more innovative companies since February of last year. But there is something to take away from this. If you think about that sine curve that I used, the weakest securities that are not suited to an inflationary environment started weakening a year ago. Companies where the earnings are way off in the future and get no benefit from inflation, in fact, get hurt. So those are things that were closest to the inflationary problem. And as time went along, other groups, one by one, were hurt. Consumer discretionary, some of the communications companies, some of the high multiple biotech stocks. It eventually got the large cap tech stocks toward November, December. And of course, as the Russia situation came and exacerbated the inflation risk, these companies have all got hit worse. But they were set up previously predisposed to weakening before the Russia conflict took place. The themes that have continued to work are themes that were well set up to begin with, had positive dynamics, and the Russia conflict has just added additional fuel for their fire. But in the end of the day, we have to pick our spots. Now, geographically, the S&P 500 and the US stock market is behaving very well. What I've done at the bottom of this chart is I've put in a relative line relative to the world index. And you can see that the S&P is strengthening versus the rest of the world, even though it is approaching its near-term lows, which are down about 15%. We know that within the S&P, there's a huge healthcare and a huge technology component, which is having the biggest impact, biggest negative impact. We know that the commodities and basic materials are having a very small impact because they're a small part of the index. So it tells us it's time to be stock pickers and tactical investors. When we look outside of the US and look at the Canadian stock market, now I'm ranking the Canadian market, the S&P 60, relative to the S&P 500. And you can see that the Canadian stock market is now having its day in the sun on a relative basis versus the US. So let's rank them globally. The TSX is acting as well as any market in the world. The S&P acting about next best. So if we were to look at where our exposures lie today, in the portfolios, we have a job to be targeted. We don't need to be everywhere. We need to identify key leadership themes. We need to assess them every day. We need to look for new leadership emerging, like the defense stocks recently. And in the event that's nothing working, hold some cash. Well, that's just not the case today. There's lots of things that are working, but it is a very tactical approach. If you were to break up the portfolios across the firm today, 65% of the holdings would be actually focused in the Canadian universe of securities. Canadian markets performing quite well. About 35% of our weight would be in the US. If you look at it from a sector perspective, not major changes in our weights, but materials continue to grow as an important part, and they're providing a lot of support for the portfolios. 22% of our holdings would be in materials, which would include forest products, agriculture, metals, golds, uraniums. Second biggest weight in the portfolio would be energy, 22%. Again, keeping in mind how big these are in the index, these are significant weights. Financials, which we've talked about now for months, have actually come down in the portfolio about 10% over the last 2 weeks. We have very small amount of government bonds. It's frankly short-term bonds that are held in our balance fund. We also have effectively a proxy for cash in some one-year bonds, just to keep some powder dry. Consumer staples are about in line with market, and frankly, consumer staples companies like Procter & Gamble have been able to raise price as their input costs have gone up based on the strength of their brands. We got a small real estate investment trust portfolio. We've got a very small communications services, and this is predominantly a couple of Canadian phone companies that have had a good dividend growth, but about half the index. And technology continues to get smaller in the portfolio at only 4%. So it's a very unusual portfolio as we sit today. Consumer discretionary, almost non-existent, and healthcare, almost 0% weight. Our job is to use our tools to try and identify where the strength is, build on strength, and take from weakness. Use our sell discipline to exit groups that stop working, and make sure that geographically we're focusing in the right areas. Now, outside of North America, there is some strength. Again, pretty far away from Russia. Indonesia's market's behaving quite well, strengthening relative to the S&P. Certainly, the Saudi Arabian market is performing well. Latin America performing quite well, dominated by commodity companies and energy companies. And Brazil. So these are all disparate, specific situations, but all of them contribute. And in our global macro portfolio, it's an important thing for us to be looking at other parts of the world. Now, over the last few weeks, the US dollar index relative to the rest of the world has gone sharply higher, which often happens when you get into a time when people feel more defensive. Our job is to understand that and be prepared to make changes. It's important to know that if we look at periods where the US dollar is rising since 1988, doesn't make a big difference to the S&P 500, but it does make a big difference to EFI markets or global markets. So when the US dollar is falling, EFI tends to do quite well. When the US dollar is rising, not so well. Same thing for emerging markets. So we take that into consideration. So just to wrap here, from a global macro exposure standpoint, our large weightings are groups that are all sort of participating at this point. Precious metals, which we held for quite some time, waiting for them to break out, are providing a lot of support in the portfolio. So is energy, so are the basic commodity and materials positions. Canada makes up a very substantial weight, 17% of the portfolio, and that's huge when you consider that Canada makes up about 3% of global capital markets. Emerging markets is down over the course of the week. We reduced our weight because of the strength in the US dollar. It's at 12%, but in those markets we've just talked about. Dividend growth continues to be an important theme because it continues to perform well. And then below that, we have our position in cryptocurrencies, Bitcoin and Ethereum, which have been trading with higher lows since December, relatively constructive, and our defense weighting. On the short side, we're short various bond issuers. US dollar short was covered last week. We have a small volatility position, which is effectively a call that we may have seen a relative low in the market. And we have a small short position in technology. Look, things are going to continue to change. We know cash positions are relatively high, so there's money that can be put to work. We know that when we look at what happens with geopolitical events, we probably have priced in what would be typical. Germany annexes Czechoslovakia. There's a 20% sell-off in 1939 heading into the war. Pearl Harbor, there's an 11% sell-off in US markets. North Korea invades South Korea, a 13% sell-off. The Cuban Missile Crisis, 6.6%. The oil embargo and the Israel-Arab War, 17%. The 9/11 attacks were 11.6%. Keep in mind, the S&P was off almost 15% on February the 24th. So not outside the realm of what has been typical. Now, we don't make decisions that way. We've got to continue to assess each of our positions, all of the various leadership themes, groups that may be turning positive, groups that may be turning negative, and look at things through an unemotional lens. But as it stands right now, we're comfortable with the positioning in the portfolios. And we look at the portfolios, the equity portfolio is down 3.5% on the year. versus just about 12% for the S&P. Balanced pool is up to 0.32. The income portfolio down about 4.5%. Long short down about 2%, and our macro portfolio up 4.1. This is as of about 3:45 this afternoon. Look, our job is to make money in a strong environment, and is to make sure that we don't give up too much when the market corrects. The reality, though, is there are lots of leaders in this current market, and emotion will help shake people out of their winning positions. We're going to try and use the tools that we have to be empirical and make quantitative decisions and keep emotion out of it. If things get more difficult, we're happy to get defensive. But as we stand right now, this is where the portfolios sit. So with that, Pam, if there's any questions, certainly happy to answer them.
Thank you so much, Dave. A great overview as always. Bill has a question. He wants to know, David, at what point can energy prices bring on a recession, and what would be the leading indicator?
Well, it's a fair question, and it's something that lots of people are trying to assess. So Cornerstone Macro this week did a research piece, and they highlighted at current monetary policy, $180 would likely bring on recession. So it's obviously a long way from here. When you take Russia out of the equation as a supplier, there is limited supply that can come from other parts of the world. So I do think it's possible we continue to see oil prices work their way higher. A lot's going to depend on what the Fed does with their policy. They've been clear to say there will be a 25 basis point hike in March, which basically took 50 basis points off the table. They are going to be assessing using their tools, but we're going to use market tools to help us assess that. And if we start seeing demand destruction or things that could cause recession, you're going to see it play through into some of the economically sensitive parts of the market that we're not seeing it play through into at this point. But it's something certainly we're going to watch.
Thanks so much,
But we
Dave.
do think oil prices go higher. And keep in mind, the energy index went down 90% from 2014 through 2020, 90%. So the fact that the group is acting well is great, but there are most companies a long way from highs. The leaders just getting back to highs now.
Dave, another question here. Do you give, or does Barometer give, substantial weight to market signals from the 10-year versus the 2-year Treasury spread? And would you become more bearish if the market saw yield curve inversion?
Yeah, it's certainly something that we have to watch. We know historically that what we're talking about is the yield on the 2-year, let's say at 1.6% versus the yield on the 10-year. And that's generally a positive spread, right? Because the expectation is there's some inflation in the future. When the 10-year yield comes down to where the 2-year yield is or goes below, that's the market assessing that there may be recession. And very often when the 10-year drops below the 2-year, ultimately you do get a recession. But we also know there's lots of occasions where it briefly dips below and then bounces, and that happened only a couple of years ago. So for sure, we have to watch that. The market is watching it. But again, it's one moving part, and we have to look at all the parts as to how they're interacting together. I think that's probably one of the reasons that the banks have backed off here a little bit, because one of the key reasons you own banks is there's a positive spread between the 2-year and the 10-year, and they can make a spread on the capital that they're deploying. So certainly that's an important thing, and we won't be the only ones watching that.
Thank you, David. Last question for this afternoon. Paul wants to know, David, how has Bitcoin, in your opinion, performed during the last few weeks? And are you happy with its performance?
Yeah, I think it's been a tough one. The fact is, on one hand, we can look at it and say, okay, so Bitcoin has certainly held higher lows, right? So we put in a low in January when the S&P made a low. We made a higher low in February when, as you can recall, the S&P actually made a lower low. So that's outperformance. So that's positive. And here we are, again, holding a higher low. All of those things are positive. I would say, though, for the people that think this is an inflation protector, it's been disappointing. But I think probably the thing we have to keep in mind is a lot of the people who are invested in Bitcoin or Ether, for that matter, are people who also have been long the tech innovators. So for those people, it's been a very difficult time. A lot of people getting margin calls, a lot of people feeling particularly bearish, because when you lose money day after day after day after day, at some point you say, I can't afford to lose more. I need to sell more of my holdings than just this. So on one hand, I think that things are actually strengthening for Bitcoin and Ether. I think they're starting to hold relative to other risk assets. I think probably this situation with Ukraine and Russia and being shut out of the global banking system makes people in other parts of the world think maybe I should hold some assets in a digital currency that's more easily transportable. But in general, I think it's been disappointing.
Thank you so much, Dave.
Just to come back to that, though, just for a second, if we take it, though, and look at it from a very long-term perspective, this is a pretty constructive long-term chart. Big rally, consolidation, big rally, consolidation, big rally, consolidation. So, again, market time sometimes feels a lot longer than people time because we get bored. But having said that, the way it's behaving is really not out of the ordinary as to how it's behaved historically.
Thank you so much, Dave. Well, that concludes the questions we've received this afternoon. So as always, David, I will leave you with the final word and look forward to seeing you next Tuesday afternoon.
Look, folks, beyond the human pain and difficulty we see going on in Ukraine, it's a difficult time for investors who are grappling with lots of moving parts. And, we take our job seriously. We are working as hard as we can to stay on top of things. We don't talk about it, but in our morning meetings, we've had Canadian generals, we've had consultants to the Central Bank of China on in the last week. We've had U.S. external affairs folks on conference calls. We're trying to understand things just like you are. And I think probably the edge that we're trying to hold on to right now is making sure that we're listening to the market signaling and not assuming that we're right and that the market's wrong. So it's going to be a fluid situation. We're going to try and continue to make good decisions. And as things either become clearer and we're able to build on strength, that's great. If things get weaker, we're starting with a pretty defensive position now. We're about 10% cash and short-term bonds across portfolios, so we do have some dry powder. We're going to take this day by day, and we'll keep you up as we go. So if you got any questions, please don't hesitate to give us a call. We're happy to answer them. I'm happy to jump on the line. Relationship managers and investment counselors are available for your help. And if you're not a client but would like to ask us some questions, we're happy to jump on with you as well. So thanks very much for joining in, and we'll look forward to seeing you all again next Tuesday.